Have you ever wondered why two investors can hear the same news about the same company and still make completely opposite decisions? Why does one panic and sell while the other calmly buys with confidence? Most people think money decisions are driven by logic, data, and careful calculation, but the truth is they're often driven by emotion, not intelligence. To see this clearly, imagine something simple. You check your phone and see your investment suddenly drop in value. Even before analyzing the reason, your heart rate rises, your mind rushes to worst-case scenarios, and you feel the urge to act immediately. Without realizing it, that single reaction already follows the core logic of behavioral finance. This is the Learning Studio, where we decode accounting and finance by first understanding how people actually behave in the real world. What's really happening in that moment is straightforward. Your brain is reacting to fear, not facts. Emotions like fear, greed, confidence, and regret quietly influence decisions before logic even gets a chance. Behavioral finance studies exactly this gap between how people should make financial decisions and how they actually make them. The same behavior appears on a massive scale in real markets. Investors rush into booming stocks because everyone else is buying. They hold on to losing investments because selling feels painful. Markets rise on optimism and collapse on fear, not because company values change overnight, but because human psychology does. Events like market bubbles, sudden crashes, meme stocks, and crypto hype are not mathematical failures. They are psychological patterns playing out in public. Traditional finance assumes investors are rational and markets are efficient. Behavioral finance challenges that idea by showing how overconfidence, herd behavior, loss aversion, and mental shortcuts shape prices just as much as earnings and cash flows. Understanding this doesn't make markets predictable, but it helps investors avoid the most common and costly mistakes. This field wasn't created as a trend, and it wasn't driven by speculation. It was formally shaped by psychologists and economists who studied how humans make decisions under uncertainty, most notably Daniel Kahneman, whose work showed that human judgment is biased in systematic and predictable ways. His research helped transform intuition about behavior into a structured financial framework used today by investors, advisors, hedge funds, and fintech platforms. Once you understand behavioral finance, money stops feeling mysterious. You begin to recognize emotional traps, question impulsive reactions, and make decisions with discipline instead of panic. You don't just analyze markets, you analyze yourself. Now that you understand the intuition behind behavioral finance, the next natural step is to explore digital finance and the fintech revolution, where technology interacts with human behavior at unprecedented speed. Stay curious, stay rational, and continue the journey with the Learning Studio. I'll see you in the next episode.